All right, let's just jump right into it. We're going to talk about a wild 48 hours in the crypto markets. Seriously, it was a period of absolute whiplash that saw billions of dollars just vanish and then reappear, almost in the blink of an eye. So, it all kicks off with a question that, probably keeps a lot of people in this space up at night. What actually happens when a market just tanks? And we're not talking a little dip, we're talking a massive, gut-wrenching loss. But, and here's the twist, what happens when that exact same market, just 48 hours later, stages a comeback so fierce it almost seems to defy logic? Well, that's the mystery we are unpacking right now. Okay, let's put a number on that initial shockwave. On October 11th, the DeFi space saw its total value locked, that's basically all the money staked in the ecosystem, plummet by over $15 billion. Gone. A massive exit of capital. And then the rebound. Just 2 days later, by October 13th, almost $10 billion came flooding back into the system. Look, this wasn't just a simple recovery, this was a violent snapback that tells a really fascinating story about the forces at play here. So, let's rewind. Let's go back to that first day. To really get a handle on this incredible recovery, we first have to understand the fall. So here's what the market looked like on October 11th. And the pain was just everywhere. I mean, beyond that huge TVL drop, trading volume on key platforms like the Virtuals protocol was down by over 26%. And the big players, the whales with their huge holdings, they pulled back too. Their trades were down a staggering 57%. It really looked like everyone was running for the exits. This drop in volume? It's like the market just froze. A 26.5% decrease means way fewer people were buying and selling. It's like the whole market was just holding its breath, waiting to see what would happen next. And you bet the experts were sounding the alarm. This quote from a Uniswap intelligence report on that day points to two really crucial culprits: extreme volatility and something called MEV. We'll get into that more in a sec, but essentially it was a huge warning sign that the market's foundations were shaky and that automated bots were just running wild. And then, right when it seemed like the market was just bracing for more pain, the script completely flipped. This set the stage for one of the most dramatic 48-hour turnarounds we have seen in a long, long time. I mean, just look at this comeback. From a drop of 26.5%, the Virtuals protocol saw its daily volume explode by 172% just 2 days later. All that hesitation was gone, completely replaced by a frenzy of activity. This was not a slow climb back. This was a rocket launch. This sentiment shift really tells the whole story. The buy-sell ratio, which just measures buy orders versus sell orders, went from perfectly neutral, 1.00, to strongly bullish at 1.46. What that means is, for every single dollar of selling, there was nearly $1.50 of buying. The market wasn't just recovering, it was aggressively optimistic. So, what on earth caused this? I mean, a $25 billion swing in market value doesn't just happen by accident. We gotta look under the hood at the powerful and often invisible forces that drove both the chaos and this incredible recovery. Okay, first, let's properly define that term from earlier, MEV. The easiest way to think about it is as profit that really sophisticated bots can make by strategically reordering transactions in a blockchain block. It's kind of like they can see your trade coming and then place their own orders just before and after yours to guarantee themselves a profit. It's this constant background pressure on the market. And let me be clear, this isn't just some niche theoretical concern. The intelligence reports from both the day of the plunge and the day of the recovery flagged MEV intensity as extreme. This tells us that bot activity was at a fever pitch through this entire event, adding fuel to the fire on the way down and then turbocharging the recovery on the way up. But hey, bots weren't the only ones making moves. Check out this data on whale activity from October 13th. The whale frequency, so the number of huge trades, is just skyrocketing. In some of these pools, it jumped by over 300%, 400%, some even 800%. The big money players didn't just return to the market, they stormed back in, driving prices and volume with an incredible amount of force. And this chart, this shows just how much power those big players really have. On the Virtuals protocol, the top 5 trading agents controlled an unbelievable 99.6% of the entire 24-hour volume. Think about that. When a market is this concentrated, it only takes a few key players to decide to change direction and the whole market just follows. This is a huge reason why that recovery was so incredibly fast and so strong. So, after all that, what can we take away from this 48-hour storm? What do these extreme moves really tell us about the nature of the market that we're all participating in?
Well, it raises a super critical question for any trader or investor out there. If this is the new battleground, one that's defined by bots and whales and these massive swings, you can't just follow the old rulebook. You need a strategy.
And when you analyze the trading data, a few clear approaches pop out. You can be a momentum chaser, basically riding these powerful waves created by events just like this one. Or you could be an early-stage speculator, trying to get into new markets before all the volatility hits. Or you could be a liquidity provider, aiming for more consistent profits in stable, high-volume markets just by facilitating trades for everybody else. So here's the bottom line, the main takeaway. These wild swings, they aren't a mistake. They're a fundamental feature of this market. The recovery was driven by the exact same forces, concentration and high-speed actors, that helped cause the crash. Understanding that whales and bots are the ones moving the market is step one. Step two is picking a strategy that actually fits the situation and, above all else, managing your risk.
Which kind of leaves us with one final big question to chew on. In a world where a market's entire fortune can be completely rewritten in just 2 days, have we moved past simple booms and busts? Is this level of constant high-frequency chaos just the new normal? Something to think about. Thanks for tuning in.